Hi, I'm Dr. Cheryl Dunn, and I'm here to demonstrate how to use 3 different depreciation methods in accounting. And so take a look at the problem. So you can see here that we have a fixed asset that has a original cost value of $38,000. You can also see that it has an estimated useful life of 4 years. And then it has an estimated salvage value or residual value of $6,000. And we're asked to take this equipment and depreciate it over its 4-year life using a straight line depreciation method, a units of production depreciation method, and a double declining balance depreciation method. And under each of the methods, we're asked to calculate each year's depreciation expense, what the accumulated depreciation would be once that expense is taken, and then what the book value of that asset would be once that depreciation is taken. The other piece of information that we're told regarding the asset's life is that it will produce, or is expected to produce, 640,000 units. They also tell us how many units the asset actually did produce in each of the years. And so we see that in year 1, it produced 200,000 units. In year 2, it produced 180,000 units. In year 3, it produced 150,000 units. And in year 4, it produced 110,000 units. So for this problem, somewhat artificially, the actual production in units equaled exactly the estimated units. That doesn't always happen, and it doesn't always happen that they are decreasing from year to year either. Sometimes the first year that an equipment is put into place, it might have a lower level of production and then have a higher level in the next couple of years. And then in the lower year, in the last year, it might have a lower production as well. But this is the information we're given, so we're going to work with it. And so first we're going to look at the straight line method. Under the straight line method, our formula is we take the cost minus the salvage value, and we divide that by the life in years. Since we're dealing with whole years here, we don't have to worry about partial years. We're going from January 1st to December 31st in each of these years. So basically, we take the 38,000 and we subtract the 6,000 and we divide it by 4-year life. And so we end up with 32,000 divided by 4, which gives us 8,000 per year. So for the straight line method, the depreciation expense is going to be equal in each of the years. That's why it's called straight line, is because it allocates the cost over the asset's life evenly in each year. And so our first year's depreciation expense would be 8,000. Our second year's depreciation expense would also be 8,000. Our third year's depreciation expense would also be 8,000. And our fourth year's depreciation expense will also be 8,000. And so that's the easiest method by far of the 3. Once we have those depreciation expenses, we can easily fill in the rest of that column as well. So the accumulated depreciation at the end of year 1, when we record this depreciation expense, we're going to debit depreciation expense for that 8,000, and we're going to credit accumulated depreciation for 8,000. And so once that entry is made, the accumulated depreciation will have $8,000 in it. The book value of an asset is the cost minus the accumulated depreciation of the asset. So in this case, we take the cost of $38,000 and we subtract the accumulated depreciation of $8,000, and that gives us the book value at the end of the first year as $30,000. We then take depreciation expense for the second year. That's going to give us accumulated depreciation of an additional $8,000 plus the original $8,000, so that will be a total of $16,000 in the accumulated depreciation. The book value then is the $38,000 cost minus the accumulated depreciation of $16,000. That's going to give us a book value of $22,000 at the end of year 2. We then take another depreciation expense of $8,000 in the third year. That brings our accumulated depreciation up to $24,000 because we've had 3 years, each at $8,000. 3 times 8,000 is $24,000. The book value at the end of that third year then would be the cost of $38,000 minus the accumulated depreciation of $24,000, which gives us a book value of $14,000. We then take the additional $8,000 depreciation expense. That's going to bring the accumulated depreciation up to $32,000. And when we subtract that from the cost to get the book value, we end up with a book value of $6,000. And that is what we should end up with if we did everything correctly, because notice that our salvage value or our residual value was $6,000. So no matter which depreciation method we use, we want to end up with a book value equal to $6,000 in all cases. As a matter of fact, you could go ahead and fill in the fact that we want the accumulated depreciation to be $32,000 in all 3 cases, and that is because we want the book value, once we are done using the asset, to equal our residual value of $6,000. Now we'll look at how that ends up happening with the other 2 methods. With the units of production method, we have a similar formula to the straight line formula, only this time it's the cost minus the salvage value or residual value divided by its life in units. That will give us the depreciation per unit. And then we multiply that times the units to get the depreciation expense. And so in this case, we have our $32,000, our cost minus our salvage value, and we're going to divide that $32,000 by the 640,000 units. So we take $32,000 and we divide it by 640,000 units. And that's going to give us 5 cents per unit as our depreciation cost for this equipment. We then multiply that 5 cents per unit times the number of units we actually produced in each period, and that will give us our depreciation expense. So in the first year, we're going to multiply that 5 cents by this $200,000 here. And that's going to give us $10,000 as our depreciation expense. That will then also be our accumulated depreciation at the end of the first year. And that will give us a book value of $38,000 minus $10,000, which is $28,000. In the second year, we use 180,000 units, and if we multiply that by the 5 cents per unit, that's going to give us $9,000 as our depreciation expense. We add that to our accumulated depreciation that was already there, so we now have a total accumulated depreciation of $19,000. If we subtract $19,000 from our cost value of $38,000, that gives us a book value at the end of year 2 of $19,000. Okay, then we look at year 3. In year 3, we produced 150,000 units. If we multiply that by our 5 cents per unit, that's going to give us $7,500 as our depreciation expense for year 3. We then add that $7,500 to the previous accumulated depreciation balance. So at the end of year 3, we will have taken a total of $26,500 accumulated depreciation. We subtract that $26,500 from our cost of $38,000, and that gives us $11,500 as our book value at the end of year 3. We then go to year 4 and we multiply the 110,000 times 5 cents per unit, and that is going to give us $5,500 as our depreciation expense. And when we add $5,500 to our previous accumulated depreciation, we do indeed end up with $32,000 in our accumulated depreciation. If we had not ended up with the right amount, we would have had to adjust the year 4 depreciation expense to make sure that we didn't over depreciate the asset and we fully depreciated the asset. In this case, we didn't have to make any adjustment because it was right on. All right. Next, we'll look at the double declining balance depreciation. And our formula for double declining balance is 2 over the life. That's the double part. And then we multiply that by the declining balance. And the declining balance is our book value. And so we have our book value, or you could write it as cost minus accumulated depreciation. So in the first year, we're going to take 2 over 4. As a matter of fact, 2 over 4 is going to be the amount that we use as the percentage every time period here. And the book value is what's going to be declining. The book value, when we first get the asset, starts out at its cost value. And so we're multiplying 2/4 times 38,000, and that's going to give us 19,000 as our first year's depreciation expense. So that's what we would write up here. That first year's depreciation expense will also be the accumulated depreciation at the end of the first year. And the book value, if we subtract the accumulated depreciation of 19,000 from the cost of 38,000, we will end up with a book value of 19,000 as well. We then take for year 2 the book value at the end of year 1. So now we have 2/4 times 19,000, and that's going to give us 9,500 as our depreciation expense for year 2. Our accumulated depreciation is going to be the total of the 2 years' worth of depreciation expenses, and so that will be 28,500. We then subtract the 28,500 from our cost value of 38,000, and we see that we have a book value remaining at the end of year 2 of $9,500. For year 3, we then would look at taking the 9,500 times 2/4, and we see that would give us 4,750. Now, what the problem is going to be is if we add up the depreciation expense for those first 3 years, we're going to end up with total accumulated depreciation then of 33,250. We can't take that much depreciation in year 3 because that's going to over depreciate this asset. Because of the size of the residual value here, when we get partway through year 3, we'll have already fully depreciated this asset. And so we can only take the amount of depreciation here needed to bring our accumulated depreciation to the total of 32,000. That's the maximum we're allowed to depreciate, because that is what we call our depreciable cost. The cost minus the salvage value, we label that as depreciable cost. That's the maximum amount of depreciation we can take over that asset's life. So instead of taking $4,750, we're going to have to subtract $1,250 from that, since that's the amount by which this is over. If I subtract $32,000 from this, that's the amount by which I would be over depreciating if I recognized that whole $4,750. So I'm going to subtract $1,250 from that, and that shows us that we can only take $3,500 as depreciation expense in year 3. So I'm going to put in that $3,500. That's going to bring my accumulated depreciation to the $32,000. That will leave me a book value of $6,000. And then in the 4th year, my calculation is very easy because it's simply 0. I can't take any more depreciation expense on that asset because I've already fully depreciated it given the original cost value and the residual value. Thank you for viewing this demonstration, and I hope you found it helpful.